You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver. Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my good friend, Yonah Weiss. Welcome, Yonah.
Great to be back on the show, Jim. Thanks for having me.
Absolutely. Thank you for being here. One of the things that I love talking about one of the things that you're an expert in, but, audience, today's guest is somebody who's saved real estate investors hundreds of thousands, millions, I don't even know how much in taxes, saved maybe hundreds of millions of dollars in taxes, but not by finding loopholes, but knowing the tax code better than most CPAs. And he's an expert in cost segregation. And we're going to talk about that. And some of you know what it is, and some of you don't know what it is. But he's a sought-after speaker. He's the host of the Weiss Advice podcast, which we just recorded. Mr. Yonah Weiss, welcome to the show. Thank you so much for being here.
Grateful to be here as well. And you're absolutely right. There are thank God our company's helped people save over $5 billion in taxes over the past 20 years. But it is grateful. One of the things that I love most about my job is that, well, to be honest, when you help people save money, they really like you for some reason. So I've made a lot of friends.
Well, if you're saving money, you're making money, right? And
Exactly.
Money is an exchange in this country, or in this world, and money gives you choices gives you freedom. And I know you're all about that. I'm all about that. So let's start here. What exactly is cost segregation, and why is it one of the most underutilized tax strategies by real estate investors?
I'll start with answering the second question first. And
Okay.
we spoke about this earlier, but it's really just the knowledge. It's the education. You mentioned there are people listening to this who probably never heard of cost segregation. I guarantee you there are a bunch of people listening to this who maybe have heard the word cost seg, but don't know what that means. And so it really comes down to education, understanding something. So that's why people don't utilize it. That is the number one reason why people don't use it. What it is, it's just a income tax strategy that helps real estate owners pay less tax. That's it in a nutshell. It's a cash flow mechanism which allows you to accelerate depreciation on your property to take more deductions in the earlier years. So to kind of take a step back, understanding what depreciation is, and then you can understand cost segregation and accelerate depreciation. Depreciation is the name of a tax deduction. So it's a borrowed term. It does not actually mean that your property is going down in value, right? Depreciation, that's what it sounds like, but it just means that when you buy a property, besides for your primary residence, any type of investment property, whether it's commercial or residential, you're able to take a deduction, literally a write-off of the entire value of that property over a long period of time. Okay, so you're taking a little bit of a deduction, about a 2 to 3% of the value every single year. And that's what depreciation deduction is. Okay, you're able to take a tax write-off as if the property was going down in value. When in fact, as you and I both know, most properties go up, they appreciate in value as time goes on. So that's why it's people call it like a phantom deduction, because it's really made up. It's completely subjective to you as the property owner and to you at the time of purchase. So it has nothing to do when the property was actually built, right? It has to do with you as the new buyer when you bought it and how much you bought it for. Okay, so it's an subjective income tax write-off for you as a property owner. So that's what depreciation is. So like if you take $1 million property, for example, we always have to take off a little bit for land. Land itself does not depreciate. Let's say 15, 20% is the general national average, but you're left over with $850,000 that you can now write off. But again, over a long period of time, 27 and a half years is the residential rate, 39 years for commercial properties. So that means about a $20,000 to $30,000 deduction you're able to take every single year just because you bought a property. So that's what we call straight line, equal amount depreciation every single year. Okay. Comes cost segregation, and it allows you to accelerate the depreciation of certain components within the property. So what cost seg does, it's an engineering study of the property, breaking down every single component and showing what each component actual value is, and then how much of that you can take as a write-off over a faster, a 5-year or a 15-year period, and with bonus depreciation, even in a 1-year period, a bunch of those components. So, like I said, it's a cash flow mechanism that can double or triple your tax write-off during the first 5-6 years of ownership. And to a lot of people, that's huge. Instead of a $30,000 deduction in the first few years, you can take a $60,000 or $80,000 or $90,000 deduction. That's going to be a big game changer for just one property. Scale that up to a $10 million property or a bunch of properties, and you're talking about having significant tax deductions that will likely reduce your taxable income to very minimal. That brings down your tax rate. And in many cases, for real estate professionals, they're reducing their income tax liability to zero, paying literally zero tax legally, because, as you said, it's about knowing the rules, knowing the system. This is considered by the IRS the correct way to depreciate your property. And so it's fascinating to me because I remember reading in a book. Everyone should check out this book if you haven't yet. It's called Tax-Free Wealth by Tom Wheelwright, who was the Rich Dad advisor. And he said over there, the main reason why people don't do cost seg, as I mentioned earlier, is they just don't know about the tax code. And the main reason the IRS does not require you to do cost segregation, even though it's considered the proper way, the correct way to depreciate your property, is, he says two things. He says it's a combination of either ignorance or laziness on the part of the individual taxpayer or their accountants. And so it's because of essentially, by paying more tax, by not doing a cost seg, it creates more revenue for the Treasury, for the U.S. government. And so therefore, they're not going to go ahead and tell you have to do certain things, but the playbook is there for those who want to learn.
I love that. I mean, it's, I've told this story, I don't know how many times, but one day I had the TV on and I was walking by, I wasn't even really watching it. And it was the Today Show. And this is like 6 years ago or something. And it said, and again, I don't care if you love him or hate him. Okay. So it said, Donald Trump is a terrible businessman. Right. He lost over $1 billion over the last 10 years. And it's like it. And I thought, they're going to tell everybody about depreciation and blah, 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 blah. And it was like, no, they just wanted to bash Donald Trump.
Yeah, exactly.
And so it was like, that's what our world does, is it doesn't want you to be educated about these kinds of things. In this series, we're doing tax syndication. This is our tax syndication series. And this is so important because if you know what's happening, you'll know what to do. So what Yonah's talking about is if you can educate yourself on what is happening, what other people are doing, then you can model what they do, right? And I believe in who, not how. Don't try to learn this on your own and go out there and try to do your own cost segregation study. Hire somebody like Yonah, and we're going to talk about how you do that and why and how to get a hold of him, everything else. But this is somebody who has experience, who's got integrity, and this is what you do first. You learn about this because, correct me if I'm wrong, but in the property acquisition process, you can't start thinking about this soon enough.
Yeah, you're absolutely right. And I think a lot of people do think about this as part of their underwriting strategy because taxes, income tax, is the biggest expense that any individual or business has. And so factoring in, your taxes to your underwriting is just smart, figuring out what's going to be my bottom line after taxes. And so if you can figure out, well, how much am I going to save on taxes by doing a cost seg? And again, we're talking about income tax, not property tax here. So then you can know ahead of time kind of what your outlook is going to be, what your forecast is going to be, having more money. And I mentioned earlier, right, we call this like a cash flow mechanism because paying less tax means you have more money. And you know better than most people, Jim, that having more money means you can reinvest that money and you can make more money with your own money.
I love it. So, I always tell people when you do infinite banking, you have money that's growing tax-free, and then you get to deduct the interest that you're paying the insurance company to use their money, right? So I say, how many things in life do you get to deduct what I mean, or you get to you don't have to pay income tax on what you're earning inside the policy, and you get to deduct what you're paying to use somebody else's money to go get wealthy. There's not very many things in our lives like that. But when you think of real estate, you brought up something super important that I want people to really take home today is you get to depreciate something that is appreciating. That right there is something that will make a difference in your life from a financial standpoint. All right, can you walk us through a real life example of cost seg, of a cost seg study that saved someone a ton in taxes?
Sure. I love examples of people who are real estate professionals that
Yeah.
don't know about this, because there is one really important thing people need to know about cost seg in general, is that it's not for everyone, and not everyone will benefit the same way, because the IRS does have certain rules regarding how you can use the depreciation deduction and who can use it for offsetting what types of taxes. So someone who is a W-2 or 1099, just someone who doesn't have the real estate professional status, they are limited, unfortunately, to only use cost seg to reduce or offset their rental or their passive income. And so there are limitations there. But someone who is, or their spouse is, a real estate professional, meaning they're full time in the real estate business, and I've seen a lot of people just go into real estate full time specifically for this tax benefit. So then you're able to use cost seg, you're able to use depreciation to offset any source of income whatsoever. So I always like to bring an example of someone who is a real estate professional, but I'll bring an example of someone who's not as well, just to kind of show you that it can work both ways. That I had a guy a couple of years back who was very successful. I think he was the top broker in his county, a residential real estate broker, and had invested on the side in his own properties as well, had a few multifamily properties in California. And so really expensive. However, he was able to, and he was making, paying six figures in taxes, paying like $400,000 in income tax every year. He was making over $1 million, and well over him with the California tax rates, crazy stuff. So he came to me. He actually read this book, Tax Free Wealth, and reached out to me. He's like, I never heard of this before. Help me out. He just bought a multifamily property for about $4 million, which, by the way, really, really important thing based on what you said before about borrowing, using other people's money. The depreciation deduction is based on the purchase price, not how much money you put in. So you can actually get a loan from the bank to pay for, a huge amount, if not, close to the entire amount of that property. And you're able to take the tax deduction as if you paid for the whole thing. So, you put 20% down on a 4 million, 25% down, a $4 million property, put $1 million down, and you're able to take the tax write-off based on the $4 million purchase. So that's exactly what he did. And we were able to, with bonus depreciation, at that time it was 100%, which means you could take 100% of the accelerated deduction write-offs in the first year. We were able to produce for him over $1 million of first year tax deduction, which meant that he was able to wipe out any income. Right. And think about it. He put down $1 million to buy the property, and he was able to get that all back as a tax write-off. Not only that, that reduced his tax liability literally to almost zero. And instead of paying $400,000 in income tax, he paid like $10,000 in income tax that year. And so that was a huge. I mean, since then he's done a ton of cost saves, bought a lot of properties, and just grown his wealth tremendously, because it's, again, that mindset shift. A lot of people think, I just deduct the taxes from my paycheck and go on with life, and complain about it because I'm paying so much tax. But you know what? Some people say if you're paying a lot of tax, that's good, because it means you're making a lot of money, right? You've heard that before. It's ridiculous. Yes. But for some people, that's like a cop-out, when in fact you can use the rules and figure out ways and strategies like cost seg to reduce your tax liability legally, and therefore pay little to no income tax.
So you bring something up, pay little tax legally. That here's one of the things that people, again, the noise that's out there. So what they do is they say, well, I don't know if I want to do that. I mean, is there an audit risk or red flags with cost segregation that people should know about? And there's always reasons. So answer that question. Are there audit risks or red flags? By the way, my attitude is the IRS can't disprove anything that you can prove.
For sure. And so obviously you want to make sure that if you're doing a cost segregation, you're doing it right. Okay, there's a right way and there's a wrong way to do a cost seg. And there's something called the Cost Segregation Audit Techniques Guide, which is on the IRS's website. They publish it, they made up the rules. And so if you follow the rules, there's absolutely nothing to worry about. In fact, as I mentioned earlier, the IRS considers doing a cost seg the correct way to depreciate your property. So it does not raise any red flags, and it will not get you in trouble in the event of an audit as long as you do it properly, meaning you hire a company that is well versed, that has the experience, follows all the rules, and knows what it right. Don't try to do it yourself. That's basically what it comes down to. But I get this question all the time, and we've been doing this for 20 years. We've done over 35,000 cost studies for people all over the country, every type of property you can imagine. And we do get people that get audited for every year, right, for various reasons. People get audited for various reasons. It's never because of the costing. However, they do look at the costing every time because it's part of the taxes. And every single time that our reports, Madison Specs, has been looked at, it's been 100% no change. So meaning they recognize the validity of following the rules, and so there's really nothing to worry about.
I love that. Are there any rookie mistakes that you've seen people make?
Oh yeah, I mean all the time. There's tons of rookie mistakes. I mean the biggest mistake is, I think for a lot of people who have maybe not been in the real estate game. Let's say someone's trying to get into real estate and they start buying properties, they start investing, maybe passively or doing whatever. One of the biggest mistakes they have is they continue on with their same CPA or their same accountant who's been doing their taxes forever, who may not be a real estate focused CPA, and therefore maybe missing out things. I cannot tell you how many times that I've had clients come back and say their CPA thinks this is illegal what you're doing, or they think it's this scam, or they don't know what this is, or they say you can't do this, or they say 100 different reasons. And literally working with thousands of clients over the years, you hear every single story under the roof. And the biggest mistake is not having a CPA who understands this. And so there are a huge resource of real estate focused CPAs out there. So if you are going in, if you own businesses and you're doing anything, you want to make sure that you have someone who's doing your taxes who's not just for lack of a better word, a pencil pusher, right? Just putting in those deductions, because you want someone who is more of a tax strategist who is going to help you plan and figure out the ways that's going to work best for you.
So I love that because, I remember one time I had one of my guys that helps us teach people about infinite banking. And he said, Jim, this CPA is on the phone with this client and the client's mad because, they can't deduct the interest that they're paying the insurance company because they're borrowing their own money. Mm-hmm. And I said, oh, they're on the phone right now? Yeah, let's put them on speakerphone. So I walked through with the CPA and I said, well, if I understand that you can't deduct money that you loan to yourself, okay, but with an insurance contract using infinite banking, you're borrowing the insurance company's money. So you're borrowing from a financial institution and you're using it to go invest in real estate, which is a deductible purpose that you would, if you borrowed from the bank and did that, you would be able to deduct the interest. And the insurance company is just another large financial institution, just like a bank. And you could hear like a pin drop with this CPA because he realized that he didn't understand how the loan worked, right? And so don't think your CPA knows everything that you might think. So I love this, and this mindset shift of thinking like this is the proper way to depreciate your property. If you take nothing away from this, let that burn into your memory. This is the right way to do it. So there's nothing to fear. But you've worked with, the people that you're talking about in these examples, wealthy investors. So what separates them in mindset shift, or what's one mindset shift that separates them from the average person?
I think just continued education is the biggest thing that separates people, because most of the people that I work with are not like these huge, wealthy corporations. Definitely we work with REITs and we work with tons of, huge, $1 billion investment firms. But I'd say the majority of my clients are individuals, who are maybe working full time and have bought short-term rentals or bought some properties, or trying to get into real estate and trying to figure it out, trying to figure out how can we make this work. And it's I love it because my background is in teaching, and so being able to educate people and having those conversations, and like you said, hearing that that pin drop, hearing like in their voice, wow, like I didn't realize that, over and over again, just educating people. So I think that's the biggest thing, is people willing to go out of their comfort zone to you know change and be different, and not go along with the crowd, and not go along with I thought I could only make money in my 401k, or in the stock market and things like that. It's to me, that's the biggest difference I see.
I love that. I mean, I feel like we could talk about this all day.
Yeah.
But one thing, that is there anybody out there that should not do cost segregation? Like, is there a threshold where it's just not worth it?
Sure. So properties, it has a lot to do. The benefit of the cost seg is a percentage of the purchase price of a property. So there's always going to be that in terms of the property itself. If the purchase price is under $200,000, I would say that's really where it kind of starts to make sense, or not just make sense, makes sense that enough that it's like a great return on your investment of the cost of getting the cost segregation done versus the after tax benefits of doing that. So that's on the property level. But again, any type of property besides your primary residence. So it can be a single family, it can be commercial, whatever it is. So that's in terms of the property. In terms of the individual, it totally depends, because there are certain people, as I mentioned earlier, the real estate professional status, if you or your spouse do qualify as a real estate professional, for sure you should be doing it. If you don't, and it could be that your regular depreciation deduction is going to be enough to cover a lot of your passive income from the properties. But there are cases where you may sell a property and you're going to have a big capital gain, and you want to use cost seg to offset the capital gain, because that can be done as well, not just using it to offset your income, to offset capital gain tax as well. So there are a lot of different strategies. And another thing that I like to bring up, which most people don't know, is there is something called the short-term rental loophole. It's not
Mm.
really a loophole. We call it that in quote, air quotes, because it's something that it's in the tax code. It just wasn't intended when this law was made. It was before Airbnb existed. And so it wasn't necessarily intended for the same purpose that's being used today. But I see now, hundreds of people that I know personally that are using this loophole, so to speak. And what it says is that if you own and self-manage a short-term rental, meaning the average stay is less than 7 days, and you are materially participating in the ownership and the rental of that property, and there are certain qualifications, how many hours you need to spend a year, it's like 100 hours. So it's not a lot. It's a very low threshold. Then you're able to use depreciation or cost seg to offset your active income as well without being a real estate professional. So it's one of the biggest loopholes or exceptions to the rule, so to speak, where I've seen personally people who are working full time, who are getting into the short-term rental business because they can do it remotely. There are programs out there. I know there's, kind of shout out to a group called the Short-Term Shop, that they're the biggest brokerage in the country that does short-term rentals specifically for investors. And they teach people how to do it remotely, how to self-manage your property remotely, build the systems. And literally, I've spoken to so many people about this, but they say that once you get the system set up, and that does take time, it's literally a half an hour to an hour per week to manage a short-term rental, and you're making a lot of money with it. And with this tax rules, you're able to save people, so much taxes. So I've seen people who are full-time, doctors, lawyers, people who are very busy professionals, and they're making more money because of the tax write-offs from the real estate than they would in their W-2. So huge paradigm shift there.
You remind me of a CPA that I used to coach baseball a long time ago, and one of the guys that was coach with me and his son played on the team, he was a CPA, and January, he was the typical CPA. January through April, he's killing himself, and then the rest of the time he's not doing anything really. I don't mean that literally, but you know what I mean. And he said to me, I make so much more money from the assets that I own than being a CPA. Now that's the kind of CPA that I want, right?
Mhm.
Is somebody that gets that. But you talked about the real estate professional. So real quick, just what are the two tests that you must pass to be considered a real estate professional?
Yeah. So either you or your spouse can qualify for this, and it works to help you both for your taxes. The first rule is that your full-time job has to be in the real estate business. I mean, you cannot have another full-time W-2 job. So you have to spend, literally the wording is 50% or more of your time is in the real estate trader business. So, and the second qualification is that you need to spend a minimum of 750 hours per year materially participating in real estate. So what does that mean, materially participating? It's, managing, operating, building, the acquisition process. If you're a broker, that counts as well. So 750 hours a year is not a lot of time. I mean, it's like 16 hours a week if you break it down through the year. But you cannot have another full-time job as well. So it means you can't just retire and sit on the beach all day and do nothing. You have to be somewhat participatory in the business, but it's a pretty low threshold. And so I've seen people where you have two couples who are working W-2s, and they get into real estate and they realize if one of us quits our job and then just works on the real estate full time, which is much, much, much less than I would have been working full time in their other job, they're going to be making more money after taxes because of the tax benefits of the cost saving.
And I love that. I mean, that's educating yourself to do something outside the herd, and it's perfectly legal, perfectly the right thing to do, and you get the benefit. Okay, two questions to wrap us up. One is what's the best advice you've ever received?
The best advice, came for me when I was a teenager from a rabbi. I'm an Orthodox Jew, a very very religious, spiritual individual. When I was a kid, I wasn't as much, but I had a rabbi, a mentor of mine, who showed me a quote from our sages. This is a quote that goes back thousands of years, and I had never really looked at it before in that light. And the quote, it says, a translation from the Hebrew, it's in a place where there isn't a man, be that man, right? Mm-hmm. Meaning in a place where you don't see a leader, you don't see someone doing something, right? Step up to the plate. And so it's about, similar to what you're talking about, like going outside the herd, but it's like take responsibility. And when you're in a place where you see there's no one taking responsibility, step up to the plate and do it. And that is one of the biggest powerful lessons in leadership that I ever learned. And, it has, a ton of depth of meaning, but I think that's helped me in my life in general as a husband, as a parent. I have 6 kids, and it's just, imparting that to them as well. But just being that leader, being someone who is showing others, by example, what to do.
I love that. That's great advice, and never heard anybody say it like that on this show. So thank you very much for that. That is incredible advice. All right, last question. If God came down from heaven and only allowed you to receive the knowledge from one book that you've read, sorry, normally I say that question so smoothly, but you can only retain the knowledge that you received from one book that you've read, what would that book be?
So the last time I was on the show, I mentioned a book called The Way of God. It's a book written in this 18th century by a rabbi from Italy named Rabbi Moshe Chaim Luzzatto. One of the most powerful books I've ever read, totally changed my life. I've read it probably a dozen times. And I would say that really contains everything that I would ever need to know in that. So, but since I said that before, I'm going to change it up. Because there's another book that also, again, being Jewish, being religious, spiritual, that's really the most important aspect of my life. It doesn't necessarily come across explicitly in my daily business dealings, but I think implicitly it is because it's who I am. And so there's another book also written in the 18th century called the Tanya. So there's not really a translation of that. Tanya, it means like teaching. But it was a book written by the first rabbi of Chabad. I think anyone's heard of Chabad, probably Lubavitch. So this was written, in the late 1700s by Rabbi Shneur Zalman from the city of Liadi. Anyways, Tanya is a very prolific book. It contains in it basically the premise of the book and what it goes through is personal development. Okay. Just basically understanding who you are, what your makeup is, that we have a constant battle within ourselves with, some call it like a good angel and a bad angel, whatever you want to call it. There are different names for it. But, we basically have a body, we have physical drives, and we have a spiritual component of ourselves who wants to connect with higher, more meaningful things in life. And we have this constant struggle in our life. And so it's literally like a daily battle internally. And it's how to overcome that and how to be in the driver's seat and how to use your mind basically to overcome your heart, essentially, meaning using your mind to think and make decisions, even if your emotions are telling you otherwise.
I love that. It's interesting that you said personal development in these teachings. I remember there's a book called Thou Shalt Prosper
Yeah.
by Rabbi Daniel Lapin, and it's interesting. Daniel Lapin, he speaks at a lot of churches, and there's a lot of churches that he goes into, and they have like kind of this poverty mentality. Is like, I have to, that's how I show that I'm like faithful, is that I'm living in poverty, which is like, if you believe in God and if God's the creator of the universe, then why would the creator of the universe want you to have scarcity? That doesn't make sense to me. But Daniel Lapin, in this book, he talks about the things that you're taught in the Jewish culture as a child, and like, here's the mindset, and it's was fascinating to me, and I love listening to him speak because I didn't grow up with that, so I didn't understand that. I learned that later in life, that you own things, you
Mm-hmm.
don't consume things, and you're not the customer of things. The W-2 person, you own things. Even if you're a doctor, you can own your practice, you can own the real estate, you can, it doesn't matter. You could be but it's just like that mentality. So I really love that you tie it all back to those ancient teachings, because I believe that everything that is in all these modern books it's all, there's all roots in books that are thousands of years old, right? I mean,
For
it's
sure.
like it's very cool. Okay, well, audience, if this episode didn't light a fire under you to start using cost segregation, you better check your pulse, because Yonah just gave you kind of a master class on legally reducing your tax bill, growing your cash flow, and thinking like wealthy people think. What more could you want? So, Yonah, how would they, first of all, Yonah's generous, approachable, and dangerous with a depreciation schedule. So you need to reach out to him and just see if this is something you could implement in your life. But how do they do that?
You can check out my website, yonahweiss.com. But I'm very active on a lot of the social platforms: LinkedIn, Twitter, Facebook, Instagram, etc. I highly recommend anyone who's listening to this, go give me a follow, a connect, but with one caveat. Do not just hit that follow button. Take 10 seconds and write a little note that you heard me on this podcast and would love to actually connect and start the conversation.
I love it. And if you're serious about building your wealth engine and escaping the Wall Street trap, subscribe and to our community, and get to Yonah's website, and follow him on the social media platforms, and do exactly what he said, is put a note in there. And if you're you got to stop playing by the rules of the herd and start owning the game. And Yonah's somebody who, that's why I'm excited. I'm sitting here looking at the clock, and I promised him 30 minutes, and we're 10 minutes over. And I'm like, I could keep talking about this for the next 2 hours with Yonah, because he's so passionate and so genuine about helping people, which I love. So I normally don't say you have to go check this out, but you have to go check this out. You got to know, just educate yourself on it. If you never do it, okay, but educate yourself on it. So, Yonah, thank you so much for being on the show, and thank you for going over on the time and being patient, and just everything that you do to help people. I'm so grateful to have you on here.
My pleasure. Grateful to you too, Jim. Thanks so much.
You're welcome. All right, audience, we're going to wrap this up like we always do with the incredible words of Earl Nightingale and the strangest secret, which is whatever you think, you become.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.